Now, I'm very pleased to have Mr. Sascha Rachar speaking with us today. Sascha is the CTO of the Universal Software System Limited, a pioneering fintech company for share registry, alternative finance, and also tokenization technology. Before Universal Software System, Sascha was the Chief Information Officer CIO of EMEA for Computershare, the world's largest global transfer agency and share registry provider, and has held various technology leadership roles in Europe, Asia, and North America. So, without further ado,
Yes, thank you very much, and thanks again for the invitation to talk to you all today. It's quite an honor to talk about, the ever-changing technology landscape, and digital assets are front and center everywhere at the moment. Everyone's heard about digital assets, cryptocurrencies, DLT, blockchain. And today I want to talk and explain a little bit the concepts around blockchain, DLT, digital assets, the different types. And I will also talk about how can these new assets be integrated into your traditional IT environment. So as Anthony mentioned before, I started as a software engineer, worked for Computershare for almost 20 years in various leadership roles around the world. I co-founded WeOwn in 2017, which is a fintech company based in Europe, Liechtenstein. And I'm now the CTO for Universal Software Systems, which is based in Hong Kong. And as mentioned before, we provide registry solutions, private market solutions, tokenization solutions for financial assets, and we're a technology company. So let me jump straight into the presentation. And so this is one of my favorite quotes from John Oliver. Everyone's heard about cryptocurrencies, and everything you don't understand about money combined about everything you don't understand about computers. So cryptocurrency by nature are quite complicated. Blockchain is a specific type of distributed ledger technology. And one of the challenges we see from a technology perspective is that a lot of people combine and a lot of people bring blockchain and cryptocurrencies together. Blockchain, DLT, is the technology base of cryptocurrencies, but cryptocurrencies or digital currency are one specific asset type of many. And as you all know, it sometimes gets a very, very negative connotation in the market. But blockchain and DLT is so much more, and I want to talk about that so much more today. So when we talk about DLT, distributed ledger technology, we look at today and in the past, most systems, services, platforms, products used to run on centralized environments. So you have a central server, you have a central data warehouse, you have a central platform environment, and you're able to modify the data as needed. Obviously with admin rights, with user or super user rights, you can modify the data and you can amend the information. Now, looking at financial services as an example, and I've worked in the equity and share registry space for a long time, you have many, many centralized systems and services that need to talk to each other. You have the clearinghouse, you have the broker, you have the stock exchanges, you have the registrars, you have all the intermediaries in the middle, and everyone manages their own data in centralized environments. When you move data from one environment to the other, you have a lot of checks and balances, and especially in the share registry space, you have a lot of overnight housekeeping routines. You have a lot of reconciliation routines to keep all the information and all the data in sync. This is the biggest challenge within a centralized environment. If you're working in a bank, if you're working in a large corporate, data consistency, data quality is one of the key challenges. And the older your IT infrastructure is, the more challenging it gets to keep data accurate, to keep data safe. Now, in a distributed network or in a distributed environment, you have multiple participants, multiple nodes, as they say, within the blockchain space. And each node or each participant holds the entire record, the entire ledger. And whenever an update happens, all the nodes need to synchronously or asynchronously agree that this data needs to be changed. Now that makes distributed networks quite powerful because they hold the data. The data can usually not be tampered with, and it keeps data quality in a quite a safe space. Now, as I mentioned before, decentralized networks, the blockchain technology eliminates effectively the need for a central authority by using a network of computers to maintain and validate transactions. As I said before, you have a number of nodes, and each of the nodes hold several transactions. And for the nodes to agree to change a transaction, there needs to be a consensus. And this is usually called in the crypto space, the consensus mechanism. There's a specific rule set or algorithm that defines a consensus, and then the transactions will get updated. Blockchain or DLT transactions are complicated to change because of that consensus mechanism, and that makes them quite secure from a data perspective. Yeah, all nodes, all participants have to agree until something gets updated or changed. And at the same time, if there's a bad node or a bad actor, there will be penalties built into the blockchain network or into the algorithm to effectively prevent bad actors from tampering or storing wrong data. There's also a big element of trust and transparency. I'm sure you've heard in the media and the news that there's been assets stolen from blockchain A, B, and Z. But what a lot of people don't realize is blockchain is actually quite transparent. You can trace back every single transaction back to its origin. A lot of the transactions are anonymous or hashed, but there is a verifiable and a transparent record of transaction, which promotes trust amongst participants and enables transparent processes. You may also have heard about smart contracts. A lot of blockchain technologies and solutions, they have a layer of smart contracts on top. And these smart contracts are self-executing, and they trigger actions and conditions automatically when certain elements or certain definitions or actions are met, and that allows for two parties to transact without the need of an intermediary, without the need of effectively a lawyer in the middle. Yeah, because the asset and for example, in the clearing and settlement space, you have the asset and the cash, and both can settle in real time by the use of self-executing smart contracts. And that is very, very powerful. So not only has blockchain transparency built in, a separation of the data store, but it also gives you smart contract ability to clear and settle, for example, in real time. And as you know, in the equity or as you hopefully know, in the equity in the share or stock space, counterparty risks in financial transactions or in financial institution is always a big problem. I'm sending the asset and I'm having to wait for T+2 for settlement times, or sometimes you have to wait in the hedge fund space, you have to wait 2 or 3 weeks for an asset to settle and for the cash to clear. And within that period of time, your cash is locked. And with blockchain technology, you don't have that counterparty risk if built in correctly, and you also don't have a locking of your asset and cash. Everything can work real time. I mentioned before the node networks. You have several nodes that communicate and talk to each other. The more secure and the more safe your blockchain environment is, the more nodes you have, because that means you have more decentralization, in the sense that more nodes can mean less power to one particular node or one particular party. Digital assets, and this is interesting. Even the terminology globally is quite different. In Europe, for example, I'm based in Europe at the moment, and in Europe we say crypto assets. In some areas you say digital assets. But digital assets are usually based on blockchain technology, and they are usually a digital representation of a real world or virtual items. So they can be a physical asset, and we had activities or projects where we tokenized real assets such as cars or watches or art. These are in the real world very illiquid assets from a fund management, a wealth management perspective, and you have the ability to tokenize and digitize these assets and make them tradable. So, but also you have virtual items. I think you've all heard about NFTs or Nifties, as they say, which are digital representations of, for example, art. You all have seen probably these weird images of apes and monkeys and yachts and all these things, and they're being heavily traded in the retail or in the, how do you say, in the younger audience space. And yeah, NFTs are quite popular, but also you have what we're seeing right now is you have music rights represented by digital tokens, or you have or you have traditionally, from the finance perspective, you have ETFs, funds, tokenized funds, obviously equity, debt. There are tokenized equity and debt, and we're heavily involved in private and public markets and helping to tokenize these assets. So tokenization converts these real world or digital assets into digital tokens on the blockchain. And it enables you, for example, fractional ownership. At the moment, a lot of markets in the traditional space can't deal with fractional ownership. For example, shares or stock, you cannot outright own a fractional share or stock. You have to own one share or one stock. You can potentially only do that with a broker with fractional ownership. But at the same time, it also, tokenization improves liquidity. Yeah, you can take an illiquid asset, as I mentioned before, art, classic cars, and you can tokenize, digitize them, and you can allow these assets to be traded. And obviously you have increased transparency. All these transactions are written, recorded in this decentralized ledger, and it allows you to understand the ownership level right down to the level of the issuance. Digital assets on the blockchain can be transferred or traded. Cryptocurrencies are heavily traded in these kind of unregulated markets or on these kind of crypto exchanges, and they're traded peer-to-peer. So if I own a digital asset, if I own a cryptocurrency, I also have a wallet, and within the wallet I can transfer my assets to anyone in the world. If I understand the wallet address, I can send it. I don't need a bank or payment provider in the middle. I can transfer these assets immediately, peer-to-peer. You may have heard about central bank digital currencies, CBDCs. CBDCs are coming more and more to life, and central bank digital currencies will basically enable the central banks to give out digital assets, a token representing their native currencies. So in Europe, we have the digital euro or the digital pound or the digital Swiss franc. China is obviously advancing heavily with their digital currency. So this is something that will change the way we clear and settle in future, which also means your technology environment, if you're managing currently payments, you need to be prepared to support digital currencies in future. I talked about smart contracts. So smart contracts are these kind of programmatic technology-driven contracts that allow you to clear and settle immediately based on conditions, based on actions. So there are a lot of types of different digital assets, tokenized assets. And we're seeing a lot in the physical space. We're seeing a lot in the finance space and the conversion into tokenization, which allows you to utilize the power of blockchain and the power of this efficient processing and transaction handling within the blockchain or DLT space. Token definitions. So I've used the European markets in crypto assets example. So in Europe, we have an initiative which is called MiCA, which is coming into effect earliest in 2024. And the regulatory bodies, especially in Europe and around the world, have been trying to put individual digital assets and tokens into different categories. And in Europe, we have the 4 categories, which I thought was worth mentioning. You have asset reference tokens. So those are crypto assets as a means of exchange. And for example, they include security tokens in, for example, investments like stocks, bonds, or securitized assets. So these are asset reference tokens, and the regulator puts them into one specific category. Then you have e-money tokens. They effectively, these are stable coins. These are cryptocurrencies that act like electronic money. Yeah. Then you have utility tokens. So, for example, you've heard probably about Ethereum, Binance Smart Chain, other type of tokens, Ether, BNB, etc. And these are utility tokens that are meant to be used to fuel and to run a decentralized network. And they are categorized by the regulator as utility token. And then the 4th one is these are significant e-money or asset-backed tokens. And these are, for example, Bitcoin. Yeah. So they have a customer base over 2 million. They have a market capitalization over more than 2 billion euros. And they're considered significant e-money or asset-backed tokens. Why is the differentiation and categorization important? Because they're treated differently from a regulatory perspective. And so first you need to categorize them, and then you can treat them differently. Utility tokens are treated differently to e-money tokens. Within e-money tokens, for example, in Europe, we have the MiFID framework, and the MiFID framework applies for the payment tokens, the e-money tokens, the stable coins. So there are different legal requirements for different type of tokens. And the regulators around the world in the last few years have been trying to identify and manage the definitions of these tokens. With anything blockchain, and I think everyone is well aware of the dangers and the challenges within the blockchain or cryptocurrency space. And I wanted to also highlight the risks and the limitations of blockchain technology for you. First of all, scalability. Scalability is always a concern within decentralized blockchain environments. You may have heard that Ethereum, as the largest smart contract and decentralized app-based network, has moved from a technology which was proof of work, where every transaction had to get validated and approved, to a proof of stake, where only certain transactions are validated and not the entire block has to be mined. For example, Bitcoin as a technology mines every individual token. So Bitcoin mining and mining as such, even on the proof of work space, is very very consumption heavy. So scalability is always a big concern. If you're running millions and millions and millions of transactions, these blockchain networks usually struggle. Now, Ethereum, with this new version and the new network, is much more performant than in the past. And for example, within my company, we've built our own blockchain network, specifically built for financial institutions. So scalability is always a concern and is always a worry. And if you pick and choose a blockchain technology, you should always investigate, is it performant? Is it scalable enough for what you need it to? I mentioned before energy consumption. So some blockchain systems use old technology, outdated mining technology, such as Bitcoin, for example, or the old Ethereum, or some other blockchains are using the proof of work or the mining mechanisms. And that is very, very energy inefficient. Now, energy consumption, if you're working in a bank, private corporate environment, ESG initiatives are super important. So you need to keep that in consideration. We have done a lot of analysis around energy usage for individual blockchains. So we've got a lot of experience in that space. But yeah, make sure you ensure you are in line with your ESG initiatives. Regulatory uncertainty. So from a regulatory perspective, a lot has been done around the world. I mean, we started building our blockchain in 2016, 2017. And back then there was hardly any regulation. Regulation has caught up. Hong Kong's done a lot. Singapore, Europe, the UK, Liechtenstein, Switzerland, these small countries have done a lot in terms of regulation. And I'll go a little bit into the differences later on. Privacy concerns. Obviously, by blockchain being very transparent, tamper-proof, you cannot alter or change a record. Once your environment is compromised, you have access to everything. So privacy, exposing sensitive information is very, very difficult. We generally advise companies not to store private or sensitive information on the blockchain. I think for transactions and for assets and for hash transactions, it's fine. But storing everything on a blockchain is anyway not advisable due to scalability and performance issue concerns. Security vulnerabilities. You all have heard about the hacks, hundreds of millions stolen, another exchange hacked, another asset stolen. Smart contracts. While smart contracts are super, super exciting from a technical perspective, where you have basically, as I mentioned before, zero counterparty risk. You have two peers trading with each other. Smart contracts, just by the nature, inherit a lot of security flaws and security concerns. The issue with a smart contract is once you deploy the contract, it's out there. It can be used and it can potentially be exploited. We've also seen in the blockchain space, a lot of startups, a lot of companies are building and writing smart contracts, and a lot of the developers are not geared or are not prepared with hardening mechanisms on the technology space, with ensuring that a smart contract is secure. And smart contract technology, for example, on Ethereum, they're using a programming language called Solidity. Solidity is very, very hard to write good code and to write secure code. It's very easy to introduce security flaws and security mistakes in a smart contract. And they get exploited because they're openly and they're public. So you need to protect them. You maybe, if you're running it as a corporate, you may only want certain individuals to access or utilize the smart contracts. There are mechanisms you can do to minimize the risk. Now, then you have, like any other technology, you have human error or governance issues. You have bad actors stealing data, stealing assets, stealing cryptocurrencies and all that, like in any other organization. So you need, to have a framework of ensuring that financial crime in your organization is managed and is governed. And then you have the last challenge is the interoperability and standardization challenge. With any new technology, and if you look back with operating systems, Microsoft versus Oracle versus Unix, you have always these challenges of new technology and which technology should I use? Which technology allows me to be compatible in future? So you need to look at interoperability and standardization when you integrate blockchain networks. There are a few studies which I wanted to share. This is a study from the Global Financial Markets Association, and it's quite recent as it's as of March 2023. And from a market perspective, the GFMA reiterates the potential to tokenize $16 trillion in illiquid assets by 2030. We have been engaged and been working with a number of asset and wealth management companies. And in terms of tokenization, illiquid assets such as art, classic cars, watches, or certain funds, they are the kind of primary focus at the moment to tokenize, because you can create tradability, which creates liquidity and which effectively increases the asset value. I think they mentioned in the past that if you make an illiquid asset liquid and make it tradable, it automatically increases the asset value by 10 to 20%. So that's an area where, especially in the wealth management, in the asset management space, there's a lot of research and a lot of projects going into illiquid assets and turning them into tokenizations and digital assets. Also, with any transaction, with any trading, especially in the debt space, you have a lot of collateralization. And collateralization you can run more efficiently. And there's an estimate that about 100 billion of US dollars can be freed up in collateral that can be deployed elsewhere. And the same for annual settlement, corporate actions in the equity space. There's a lot of savings and a lot of benefits you can utilize by using blockchain technology. Yeah, we see, and also the GFMA see the greatest benefit in the post-trade servicing space. So clearing and settlement, custody and asset servicing. Those are the prime areas within financial services to focus on tokenization and blockchain technology. We've done foreign currency post-trade conversion projects and basically making that process more efficient. We've built a post-trade engine for equity and the settlement in that space for private markets. The private market space is a great area to deploy blockchain technology and to allow private deals to happen more efficiently. And we've got technology around that. Again, yeah, this is a statistic from the World Economic Forum in combination with HSBC. And the World Economic Forum predicts that, up to 10% of global GDP will be stored and traded via DLT technology in 2027. Now, it will be debatable, is it 2027 or 2030? But, tokenization of assets is happening, it's starting, and, every financial institute is doing projects and is trialing these technologies. Just coming back to Hong Kong, I know there are a number of viewers here from the SFC, so I think Hong Kong has done really well. I mean, I've got a global view at all the regulatory happenings around the world, and Hong Kong, from the general perspective, has applied a very cautious approach. So, the SFC has been actively regulating DLT and virtual assets pretty much since the beginning. During the Hong Kong FinTech Week in 2022, I think it was mentioned and highlighted that Hong Kong has the ambition to become a major DLT and blockchain hub. And it has been expressed by the government's vision and approach. The SFC, again, in December 2022, highlighted a paper to warn for the risks and the potential legal requirements associated with virtual assets. And that's something we've seen around the world, where all regulators have urged the general public, the retail investors, to be cautious, to be careful. A lot of financial products are called financial products in the traditional sense, but have little to no protection for retail investors and consumers. And that is a worry, and that has always been a worry around the world. Similar to, for example, the UK and other regulatory environments, Hong Kong has the virtual asset provider registration regime, which is heavily combined with AML and counter-terrorist financing amendments in the legal environment, and the same as in the UK and same as around the world. And there's a big worry with cryptocurrencies and exchanges, crypto exchanges, to be financing, illegal, to finance and support money laundering. So that is being prevented by Hong Kong, by others. And as I understand, in Hong Kong, there are a lot of projects and initiatives underway to, for example, central bank digital currencies, which is also something we see around the world, tokenization for green bonds, virtual asset ETFs, property rights, stablecoins. So a lot of these initiatives are underway, and I think Hong Kong provides a great environment for fintechs, for startups to start and build and base their business model around. So how does it compare to the rest of the world? And I just picked a few that I know quite well, and I also picked a few that, where there's different regulatory initiatives happening. So Liechtenstein, Principality of Liechtenstein, and in my previous company we we were based in Liechtenstein. We were talking to the regulator in 2017. We're working closely with the government. And Liechtenstein was the first country to effectively introduce a blockchain law. And it's called the Token and Trusted Technology Service Provider Act. And Liechtenstein was the first country to create a specific bill and law that defines the token, its use of the token, and the legal environment, and where, for example, securities law or other laws apply. And it was the first legal framework that a country has come up with, and it was the basis, and it's been used in a lot of other regulatory environments, and to be used as a baseline for other regulatory initiatives. Europe has a really good framework. It's the Markets in Crypto Assets, the MiCA regulation. It was introduced in 2020, and it will come out in 2020 earliest. MiCA covers the issuance and servicing of digital assets and investor disclosure requirements. And MiCA also defines what service providers, investment firms, etc., are allowed to do and not allowed to do. For example, where MiFID II applies or where it doesn't apply. So it goes actually quite broad, and it covers the entire life cycle from the issuance, the servicing, and the trading side in the financial services space. Unfortunately, what MiCA and some of these environments do not cover are the new asset types like NFTs, for example. But that is probably or hopefully being amended. Yeah. The UK, and at that time I was based in the UK, it was one of the first countries to recognize the potential of DLT technology. The government had a lot of initiatives, especially in the registry space, for example, property rights, property law, legal title, equity, debt registration, and services around that. So the UK government had a lot of initiatives. I think due to the Brexit, due to the change with COVID, etc., the UK has slowed down a little bit, and at the moment it only regulates crypto assets based on the AML type initiatives. And because it isn't part of Europe, it's not part of the MiCA framework. So UK started really strong, but lost a lot of traction compared to others. Germany is quite interesting. Germany is very innovative in that space. I mean, Germany is not known to be always the innovator and to be first, but Germany introduced something called the EWPG. It's an electronic law that makes it possible to issue bearer bonds, mortgage bonds, and specific fund units in purely electronic format. So 100% dematerialized without the need of a notary or of a lawyer. You can issue these specific assets on a DLT, on a blockchain, and they are legally binding in that sense. There's also a view that electronic shares will be put into that legal framework. So the exchange and the trading of shares will happen or can happen and is allowed to happen on a DLT and a blockchain. So this is the ultimate dematerialization where a lot of markets will move into. We know because we have projects in Hong Kong at the moment dealing with USM, uncertificated securities market. So the new dematerialization regime in Hong Kong, which is very, very exciting and overdue. And I think USM in future will be a great showcase for DLT and blockchain. And we have currently a number of projects in Hong Kong to deal with USM and DLT. So that's an exciting space in Hong Kong. But in Germany, that law already exists, and that will happen in the next 1 or 2 years. Yeah, so that's quite exciting. The US is typical US from an SEC perspective, they have really always a watch and learn approach and watch and see. And when someone oversteps, they go in really hard. So the US and the SEC has implemented a lot of enforcement actions against exchanges. You've probably seen around the media with FTX, the fallout of FTX, the issues with Binance and these cryptocurrencies. But what the US do not have yet is a real framework. They're applying it into the existing environment. And to launch and issue tokenized assets and crypto assets in the US is hard and almost impossible at the moment. But I think it will change, and a lot of these regulatory environments will catch up. But it's very interesting to see. So Europe has a really, really solid, good framework. The UK is a very hands-off approach, more around AML. And Hong Kong, I think, is watching and learning and seeing and then acting. And that's the right approach. If you act too early, then you might get caught out. Liechtenstein was introducing the legal framework really, really early and quickly, but the commercial success wasn't there. So in terms of use cases, there are many, many use cases for blockchain. I won't go into the details because I think we're also running out of time. So we have digital payments, we have supply chain management, we have financial services, a lot of post-trade servicing, which we as a company are focusing on, and even voting systems. So for example, we've built a voting system for blockchain, for AGMs, to ensure that votes cannot be altered or changed, which especially in the AGM space, in the equity space, is really important. But there are many, many more use cases for that smart contract, for counterparty risk reduction, immediate real-time and settlement. So what are the areas where traditional finance are applying projects and use cases on at the moment? The title of this presentation was traditional finance. So what are banks, for example, in Europe focusing their time on? At the moment, they're looking at trading of native digital assets. So this is the easiest. You as a bank, you want to allow your customers to trade cryptocurrencies or payment tokens. And pretty much every bank has an initiative and has launched an activity around being able to offer these sort of services to their customers. We're also seeing a lot of tokenization of private assets and issuance. But private markets by nature are very, very chaotic. They're very fragmented. Yeah? And there's hardly any standardization, hardly any regulation in a lot of that space. And tokenization of private assets and issuance in that space gives you a lot of efficiency. It gives you a lot of control. It gives you a lot of standardization, and it reduces your cost tremendously. So that's a good area. And a lot of financial institutes in Europe are focusing on that. Peer-to-peer marketplace secondary trading, that's something that's being looked at. And then wallet-based custody of payment services. A lot of banks, a lot of financial institutes are looking to get into the custody space, to allowing digital assets to be managed, to act as a custodian. By nature, the banks and the financial institutes are the best places to be a custodian for digital assets, to manage these assets. Again, we had projects and we have technology solutions to help banks integrate these sort of services. And then things like KYC, AML, on-chain analysis. There's a lot of identity management services that can be applied to blockchain. And then you have future transformation cases like central bank digital currencies. Central bank digital currencies will happen. It's just a matter of time, and it's already happening in China anyway. And if your financial institute, your payment processes, your payment services, from a technical perspective, have to be able to use these digital assets. So you should get familiar with digital assets now, because it will happen in future for you. So how would you integrate these digital asset elements into your banking environment? And this is just a core banking system integration example. So what we've done, for example, we've created a digital asset gateway that links a core banking system into the digital asset and public blockchain space. So you can offer crypto trading, you can manage tokenization, issuance, and servicing, similar to share registration. And we have a share registration suite you can manage your digital assets. You can manage the issuer, you can manage the issuance, you can manage the investor, the holder, and you can allow these things to be traded in like a peer-to-peer space, or you can connect to an exchange, a stock exchange or a crypto exchange. So these things you can simplify by creating gateways, creating APIs and adapters. And then you need a custody provider, you need the reporting and analytics, you need financial crime solutions, you need the compliance tools and all that. And you can integrate and segregate digital assets from your existing assets quite nicely through a technology like that. So what are the general DLT integration challenges? A lot of technology frameworks are still immature and quite costly. And there are few to almost no enterprise solutions available. I mean, IBM, Microsoft, they used to have, I think Microsoft had the Spark framework, IBM had the Hyperledger blockchain environment, but there are hardly any enterprise solutions available. Also remember that the benefit of decentralization is to utilize an open network. If you run a private network, if you run a private blockchain, you're defeating the entire benefit of utilizing a blockchain because it's not decentralized anymore. So if you use a private blockchain, you might as well just use a private, just a normal database. Yeah, you have no benefit. I think the access to public markets, the access to public decentralized applications is through public blockchains. So for example, Ethereum, we always support, for example, Ethereum. We have our own blockchain, but you know, Ethereum as an ecosystem and environment is very large, is very powerful. So when you integrate DLT technology, you need to work very closely with your compliance, your risk, and your legal teams, because the legal landscape is constantly changing. What is now might change in 12 months. That creates uncertainty, that creates fear, especially with your compliance teams. And they need to be your friend. You need to be close to them. And every project should go hand in hand with your compliance and risk teams. You need to be careful about blockchain interoperability. You know, what you're using today may not be sufficient next year or 5 years. So you need to ensure you have interoperability features. We've seen a lot of projects that have been using the old Ethereum, and suddenly their transaction fees went from a few cents to $1,000 per transaction, and that kills any business case. So Ethereum went through this massive spike of transaction fees in the past, and you don't want to run your project or your business on an environment where transaction fees go through the roof, you know, and kill your business case at launch. Choosing the right technology and the partner is challenging, as unfortunately the crypto space is full of evil and inexperienced actors. So you have a lot of young startups, they have no idea about how to build scalable system, but they're selling their solutions. So you need to be careful, and you need to ideally go with veterans or more seasoned people, and also be careful with consulting firms. Consulting firms usually only work with 1 or 2 startups or 1 or 2 technologies. And if you want real technology integration, work with real technologists, not just with consultants. Yeah, blockchain or DLT, it shouldn't be treated as something else. I know there's a lot of hype around the business, the areas, and what it can do, but you should treat it like any other technology project. It is a technology project, and it will come with the same technology integration delivery risks. So if you had bad experiences with technology projects in the past, it will probably be the same. Yeah, so treat it like a technology project, but engage compliance, engage business side, you know, make sure that it's run as a good project, you know, implement agile principles, deliver it, you know, quick and often, and learn from issues. Yeah? A lot of pilots. So we're seeing 3 or 4, 5 different blockchain pilots across all financial institutes around Europe. And you should also have a number of pilot projects right now to familiarize yourself with that asset class. Don't believe all the hype. There's been a lot of hype around DeFi, and you can get 100% APR or 20% APR, and a lot of these things are too good to be true. So you got to be careful. A lot of cryptocurrencies and blockchains are massively hyped and overinflated. The technology underneath is often just copied and pasted from other blockchains. So you have to be careful, and you have to really look underneath the hood. What are the critical integration factors for financial institutions specifically? Tokenized assets, so digital assets, are considered a new asset class or a supporting asset class. But at the end of the day, if you're integrating them as a bank, they need to be bankable. They need to be in your deposit. They need to be in your portfolio. You need to be able to deal with digital assets across your existing legacy technologies or system space. At the end of the day, these tokenized financial assets, they always need to be bankable in some way or form. Consider your existing capabilities in infrastructure environment. We have a lot of people coming to us asking, we want to go to T+0, but your whole environment, your operations environment, your network operations center, your support staff aren't 24/7. So don't implement a technology that is 24/7, but your support staff are only 9 to 5 or something like that. Your whole environment needs to be prepared for that. You can integrate vertically and horizontally via service bus, gateways, middle layers, utilizing existing APIs and interfaces. You need to make sure to integrate with the core banking system and ensure you have the regulatory and compliance tools to be able to triage blockchain data and to manage integration seamlessly. You always need to integrate blockchain technology and assume something goes wrong. That's how you deploy technology. You don't deploy technology into, everything will be great. You will deploy technology assuming something will go wrong. And that's how you have to manage and handle, and you have to have the right monitoring tools, the right support staff to handle that sort of stuff. Sustainability, I mentioned that before. Make sure you are in line with ESG and with initiatives, and make sure that you are picking a sustainable blockchain, a sustainable technology. And then be flexible. This is with any technology. The technology is evolving, it's advancing. There's new blockchains, new methods coming out, new algorithms, new cryptocurrency methods, and you need to be flexible. So I think I went over by a little bit, but I think we're still in the Q&A space, and I hope I gave you a little bit of an idea what digital assets is, the individual types, and I hope you found it interesting, and I hope you have lots of questions to me.
Thank you, Sascha, for sharing your view. I'm sure a lot of the audiences in the classroom today, same as me, would be relatively new to this topic. We've heard about so many of the buzzwords, but thanks for really laying the very strong cornerstones for us. And we have now come to the Q&A time. So please use the chat or the Q&A function to submit your questions, and Sascha is going to address them. So I'm looking at the Q&A panel. Let me start with the first question. It's about, can you explain the energy consumption issues and in a bit more details? There is concerns and tighter regulation and restrictions around ESG-related topics. Blockchain is almost always mentioned as a negative energy consumer. So, Sascha, what do you think?
Yeah. I mentioned before the mining of blockchain, for example, Bitcoin, is based on algorithms and a cryptographic puzzle. So the puzzle gets more and more complicated, which means you need more and more processing or calculation power to solve these puzzles. And the more power you need, the more energy is being consumed. So you've seen these crypto miners in the past. They go to low energy countries. So for example, they've been to Iceland, they've been to China, where there was a lot of traditional mines and where the energy costs were low to be able to solve these puzzles. And they had massive farms of GPUs, graphical processing units, to solve these puzzles. If you wonder why NVIDIA and a lot of these video graphic computer game companies were suddenly where the share price was so high, is they have GPUs, graphical processing units, and these GPUs are perfect to solve puzzles. These GPUs are also perfect for AI and artificial intelligence. And that's why NVIDIA, for example, is one of the most, most valuable company right now because of the trends and initiatives in AI. So the more puzzles you have to solve, the more energy consuming it is. But new technologies around delegated proof of stake, they don't solve puzzles, they only validate, and they give incentives for nodes to validate specific transaction. And that energy consumption level is very, very low and is much more efficient.
Thank you. Thank you. So in your opinion, what are the areas where tokenization will generate the most use?
Yeah, I mean, tokenization, I think works perfectly in illiquid assets. And I'm seeing there's a question, and how do you tokenize collectibles like art pieces, watches, etc. So when you tokenize, for example, an art piece or a watch, you need a custody provider. You need someone that can effectively warrant that this piece of art, that this piece of watch exists, and they usually hold that in a vault. Yeah, so they do that, for example, in Liechtenstein and Switzerland. There are vaults where people keep their classic cars, they keep their watches and their art. And that custodian or that trustee effectively can confirm and certificate that piece of art and that watch. Yeah? So we're coming back to certificates in the physical world, and then you can tokenize that asset. For example, you can have a car, and you can break up a car into 5 pieces or 10 pieces, and you can give it to 5 or 10 shareholders. And they can benefit from things like, if your cars goes to museums or to art collection shows, you earn revenue, you earn a dividend through them traveling. And that is a dividend you can connect to a digital asset. And that's how you can earn passive income. Yeah. That's just a tiny example, but we can, if you have questions, get in touch with me directly and we can explore options. Yeah.
Thank you. And that also answers another question from the floor about any suggestions on how to tokenize collectibles like art pieces and watches, etc. So that's amazing. Another very related but follow-up questions, which the audiences would like to thank you for the presentations, was very insightful. She would like to know that whether besides share registry and private marketplace, any other products that would be able to offer for the financial industry?
Yeah, I mean, it's you can tokenize and digitize anything. Yeah, I mean, debt, private debt, public debt is very, very popular. You can tokenize entire fund units. If you think about funds, if you think about an ETF or fund, you have a fund manager, you have a fund administrator, you have a lot of intermediaries in the process. And you can, if you tokenize a digital assets and put them into a portfolio, you may not need a fund structure anymore. Again, you have regulatory and bankable requirements. So, for example, in the global world, you need an ISIN. You need an ISIN in the equity in the fund space to be able to trade a financial product. Yeah. But in the private market space, for example, you don't necessarily need an ISIN. You just need a marketplace. Yeah. And that's where a lot of these things are happening. But you can also tokenize an asset and put an ISIN on top of it. Absolutely, that's all possible. So a lot of those things are being explored. I mean, we've worked in the fund space, we've worked with equity and debt, private markets, and we can help people guide through the journey. Yeah.
Sure, wonderful. And talking about tokenizing some of the valuables, that's definitely ties to the questions on valuation. So we've got questions about how to value those tokens owned by the funds, and can you discuss any parties that would be qualified or credible to perform those kind of valuations?
Well, valuation is definitely an area of challenge for these assets. I mean, you cannot allow the market to value your item. If you look at the traditional stock exchanges, the biggest benefit a stock exchange in the equity space gives, it gives you a price. It has price discovery features. So you need to explore, where does the price discovery and the price come from? It comes from maybe a public market space. It comes from your own market space. But equally, every asset and fund manager has a means to value an item and value an asset. Yeah? And you can apply a value to any of these assets. It doesn't need to be purely by price discovery and trading. You can, every token you can assign a value to, and you can do that internally with your own capabilities. Yeah.
Thanks. And we could move on some questions to the floor about the downside protection. So the first one is about contract disputes. So in the unlikely event that happens, in what jurisdiction would this dispute could be settled? And any examples of any jurisdiction are prepared to settle any of those disputes?
Yeah, that's a great question. That's a great question. And that comes down to, for example, decentralized protocols. The regulators are struggling around the world to assign ownership and responsibility to decentralized, where do the servers sit? Do they sit in China? Do they sit in Europe? Do they sit in the US? Who's responsible? Interestingly enough, in Europe, they made the programmer, the engineer, the last kind of line. So if you, as a developer, have created a decentralized protocol, you are effectively liable wherever you are. Now the challenge from a regulatory and from a financial crime perspective is finding these people, because they play cat and mouse, they run around. But those are the disputes. In terms of actual financial digital assets, so digital assets created by financial organizations, you need to have a dispute mechanisms, and you need to issue and originate in a good country. So if you create a digital asset and you launch it in Hong Kong, your place of jurisdiction is Hong Kong, with all the legal requirements and all the laws that apply. So if you want to do that via Switzerland or via the UK, it's Switzerland or the UK. Yeah. And again, in the past, we've seen a lot of crypto or token issuers trying to find the jurisdiction which has the least hard requirements. But a lot of the investors and a lot of the consumers are cautious now. They want you to be listed, to be issued in a country that gives enough protection and security and safety.
Perfect. The time is just now 2 p.m. and we have got most, if not all, of the questions answered. So once again, thank you so much, indeed, Sascha. It's such a great afternoon spent with you.
Thank you very much. Thank you.
So